You lost money today, and yesterday, and every day before that.
You do not own one smooth blob of Bitcoin. That sounds strange because every wallet shows you one balance. 0.01 Bitcoin, zero point 0.1 Bitcoin, 1 Bitcoin. The app makes it feel like a single pile. But under the hood, Bitcoin works more like a drawer full of bills and coins. A $10 bill here, a $20 bill there, a handful of quarters. Every time you receive Bitcoin, your wallet gets another piece. Those pieces have a name, UTXOs. UTXO stands for unspent transaction output. It is one of the least friendly terms in Bitcoin and one of the most important. Because if you use Bitcoin long enough, your UTXOs affect your fees, your privacy, your future spending, and your records. So today, plain English, what a UTXO is, why your wallet hides it, and how tiny repeated buys can quietly turn into a messy wallet later. Start with the cash analogy. If you have $100 in your pocket, that could mean $100 bill, or 5 20s, or 10 10s, or a giant pile of singles. All of those add up to the same balance, but they do not behave the same when you spend them. If your lunch costs $18 and you only have a 20, you hand over the 20 and get $2 back. You did not cut a little $18 slice out of the bill. You spent the whole bill, and the cashier returned change. Bitcoin works in a similar way. When someone sends Bitcoin to your wallet, the transaction creates an output. If that output has not been spent yet, it is an unspent transaction output, a UTXO. Your wallet balance is just the sum of all those unspent pieces. So if your wallet says you have 0.05 Bitcoin, it might be one clean UTXO worth 0.05, or it might be 50 tiny UTXOs worth 0.001 each. The balance looks the same. The wallet underneath is very different. Now imagine you want to send 0.02 Bitcoin. Your wallet chooses one or more UTXOs to fund that transaction. If it selects a UTXO larger than what you are sending, the transaction usually creates change back to you. If it needs several small UTXOs to cover the amount, it gathers them together like a handful of small bills. That is the part most people never see. They see send, receive, and balance. Bitcoin sees inputs, outputs, and change. That difference matters first because of fees. Bitcoin transaction fees are not based on the dollar value you send. They are based mostly on how much data your transaction takes up on-chain. A transaction with one input and two outputs is usually smaller. A transaction with 20 inputs is larger. So one person might send $1,000 worth of Bitcoin using one input. Another person might send the same $1,000 using dozens of tiny inputs. The second transaction can cost more in fees because the transaction is heavier, even though the dollar amount is the same. This is the part that surprises people. In normal banking, a transfer for $100 and a transfer for $10,000 often feel like the same action. Type the amount. Hit send. The bank moves numbers in its database. Bitcoin is not moving a bank database number. Bitcoin is building a transaction out of previous outputs. The network does not care that your wallet screen says one balance. The network sees the pieces you are spending, the new outputs you are creating, and the space that transaction takes in a block. That is why the question is not only, how much Bitcoin do I have? It is also, what shape is my Bitcoin in? That is why tiny UTXOs can become a problem. If you buy small amounts on an exchange every day and withdraw each tiny buy to cold storage, you may be building a wallet full of small pieces. That can feel disciplined. It can also create future fee pain. There is nothing wrong with dollar cost averaging. The issue is the withdrawal pattern. Buying small amounts is one thing. Creating hundreds of tiny on-chain pieces is another. When fees are low, you may not notice. When fees are high, some small pieces can become uneconomical to move. In plain English, a tiny piece of Bitcoin might cost a painful percentage of itself to spend. This is why people talk about consolidation. Consolidation means combining multiple UTXOs into fewer, larger UTXOs. It is like exchanging a pile of singles for a few larger bills. But do not hear that as, always consolidate everything. Consolidation has trade-offs. It can reduce future fee pressure. It can also reduce privacy because combining separate pieces in one transaction can suggest those pieces belong to the same owner. So the right lesson is not merge everything. The right lesson is understand what your wallet is made of before fees or privacy force the issue. That brings us to privacy. Bitcoin is public. Not public in the sense that your name is stamped on every transaction, but public in the sense that the chain can be inspected by anyone. If you have 10 separate UTXOs and later spend them together in one transaction, you may be linking their histories. A chain analyst may not know your name, but they can see that those pieces were likely controlled by the same wallet at the moment they were spent together. This is one reason self-custody is not just about owning your keys. It is also about using your keys thoughtfully. If all your Bitcoin sits on an exchange, the exchange sees everything it controls for you. If you withdraw to self-custody, you get control, but you also inherit responsibility for how your wallet pieces are managed. Control is good. Blind control is messy. The wallet interface can make this worse because many wallets hide UTXO selection by default. That is fine for beginners. You should not need a graduate course just to receive Bitcoin, but as your balance grows, or as you plan larger future spends, or as you care more about privacy, the hidden machinery starts to matter. The beginner mistake is thinking one address equals one account and one balance equals one pile. Bitcoin is not a bank account. It is a set of spendable outputs. Your wallet is software that tracks them, chooses them, and builds transactions from them. And that is why just send it to cold storage is incomplete advice. Cold storage is excellent when it is done well. It reduces exchange risk. It gives you control over your keys. It makes Bitcoin feel less like a brokerage balance and more like property you actually hold. But cold storage is not a magic spell. If you send tiny pieces into it forever, never label anything, never learn how your wallet chooses coins, and never understand change outputs, you can create a different kind of future headache. The goal is not to scare people away from self-custody. The goal is to make self-custody less mysterious. Once you understand that, a few practical rules become obvious. First, do not create dust for no reason. Dust is a tiny output that may be annoying or expensive to spend later. The exact threshold changes with fee conditions and wallet policy, so do not get hung up on one universal number. The idea is simple. A piece can be so small that moving it is not worth the fee pain. If you are moving Bitcoin off an exchange, think in terms of meaningful withdrawal sizes. That does not mean leave everything on an exchange forever. It means do not reflexively send every tiny buy on chain if the result is a wallet full of crumbs. Second, label what you can. Many wallets let you label transactions, addresses, or coins. Labels are boring until they save you. Was this from an exchange withdrawal, a business payment, a test transaction, a consolidation, a gift, a transfer between your own wallets? Those labels can help future you understand the wallet without reconstructing a mystery. Third, keep records separate from the wallet. This is where people confuse two different things. A UTXO is not the same thing as a tax lot. A UTXO is an on-chain piece of Bitcoin. A tax lot is a record-keeping concept. What you acquired, when, for how much, and what happened when you disposed of it. Sometimes the two line up cleanly, often they do not. If you bought Bitcoin on an exchange, withdrew it, moved it again, consolidated it, and later sold part of it, your wallet history and your tax records are related, but they are not the same object. That is why the last episode mattered. Form 8949 is not created by magic. Your records explain what you sold, what it cost, and why. UTXOs are the physical structure of your Bitcoin wallet. Tax lots are the accounting story behind your acquisition and sale history. Do not mix them up. Here's a simple way to separate them. The blockchain can show that a piece of Bitcoin moved from one address to another. It can show the transaction ID, the amount, and the timing. Your records explain the human meaning. Was that a purchase? A transfer to your own wallet? A sale? A payment? A consolidation? A move from one custodian to another? A blockchain explorer cannot know that context by itself. So if you wait years and then ask your wallet to explain your whole financial history, you are asking the wrong tool to do too much. Fourth, test before you move big amounts. If you are new to self-custody, send a small test transaction first. Confirm the address, confirm the wallet receives it, learn how the transaction appears. But do not turn every normal transfer into a permanent stream of tiny outputs forever. There is a difference between a test and a habit. Fifth, if you consolidate, do it intentionally. Consolidation can be useful when fees are low, when you have many small UTXOs, or when you want to simplify future spending. But it can also reveal relationships between coins. You should understand the trade-off before you click send. This is not a call to panic. It is the opposite. Most people do not need to obsess over UTXOs on day one. If you are buying a little Bitcoin and learning the basics, learn calmly. But if you are building a long-term stack, moving to cold storage, and planning to hold for years, UTXOs are part of the maintenance layer. The good news is that this is manageable. You do not need to memorize every technical detail. You need the mental model. Your wallet balance is not one blob. It is a set of pieces. When you spend, your wallet selects pieces. When the pieces are too small or too numerous, fees can hurt. When you combine pieces, privacy can change. When you move pieces across exchanges, wallets, and years, records matter. That is the whole idea. Think about the difference between two people with the same Bitcoin balance. Person one bought occasionally, made a few meaningful withdrawals, labeled transactions, and kept exchange records. Person two bought every day, withdrew tiny amounts every day, never labeled anything, changed wallets, consolidated randomly, and then tried to sell years later. Same headline balance, very different wallet. That is the point of this series. Bitcoin rewards people who understand the boring structure before it becomes urgent. The flashy part is price. The durable part is custody, fees, privacy, and records. If you remember nothing else from this episode, remember this line. Your Bitcoin balance is the headline. Your UTXOs are the receipt drawer. And a receipt drawer can either be clean enough to use or messy enough to punish you later. Next time, we will connect this to wallet labels and self-custody records, the boring system that makes your future sell, transfer, or inheritance much less chaotic. Educational only. This is not financial, tax, or legal advice. Learn the structure, keep your records, and ask a qualified professional for your specific situation.